All right, I think we've crossed the 50 mark of people coming in, so that's a good sign of we can get things started, I think. So, morning everyone. My name's Ashley. I'm the communications manager at the AADA. Thanks for taking the time to come along to another AADA webinar. Today we've got Lee Peters and Andrew Moore from Deloitte to take us through some data on dealership profitability and performance. Lee and Andrew have been around the dealership landscape and presenting, I'm sure, to many of you before probably. So you're in capable hands today with some interesting points to cover as well. Before I hand it over to them, I'll just do a couple of little housekeeping bits and pieces. There will hopefully be time at the end of the presentation for a few questions. So if you think of anything while the guys are talking, you can use the Q&A function at the top menu bar, put your question in there, and we'll try to come back to it and answer it at the end. If we can't get to it, because they've been talking too much, they've got too much to say on some interesting points, we'll email you afterwards and try to come back to the question regardless. So there will be a version of the presentation made available to you after the session. I'll email out the slide deck to everyone who made it today. So that will come to you afterwards. And finally, the webinar is being recorded, mainly just so we can catch the video replays of all the good bits throughout it. So without any further preamble, I'll hand you over to the capable hands of Lee and Andrew.
Thanks, Ash. I think you might know us too well by now. Ash originally gave us 60 minutes and we had to beg for 75. So thanks very much, Ash. And yeah, hopefully we can get to some questions at the end, but thanks very much for joining. We're up to 60 now. And yeah, appreciate your time and look forward to sharing some stories about, what the data's telling us and showing us. We've cut some unique ways of looking at the data for half one 2025, and yeah, want to sort of try to bring some of that insight to life today. So thanks very much for joining. We'll get into it, and hopefully some of the latecomers can just join us as we go. So as Ash mentioned, Lee Peters, partner in our Deloitte Motor Industry Services team, and Andrew Moore, one of our managing directors. We've been with the group. I've been with the group for 20 odd years, Andrew for the last 5, and we'll be with you for the next 75 minutes. The data that we come and bring you today comes from our Profit Focus platform, which is, as you can see, around 2,000 plus dealers. Around 7 out of every 10 dealers in the country at the moment is reporting at least one of their brands through the platform, and it's a good data set to be able to get a real sense check, a real pulse of where the market's at. And as you'll see, there's never a dull moment in the automotive industry. So we'll get on with it. As we go through, and you might have seen this before in some of our presentations, we try to look at the data through 3 different lenses. How do we take the insights to optimize dealer performance today? How do we use some of those insights to help dealers navigate the changes of tomorrow? And then hopefully we can get ahead of the curve and use it to shape the future of the automotive industry that we all know and love. So just the brief agenda before we get into it for the session, we're going to give a sort of 30,000-foot view of some of the key changes and key machinations of the industry at the moment, before we then deep dive into what was the performance of the industry through H1 2025. We'll then break down, as we do, each of the departments and get very operational around some of the core operations of your dealerships, individual departments. Have a look at your cost structures and what are some of the insights coming out of that, and then roll some scenario planning through this. So what does that mean going forward for the industry? And then finalise with a look at what benchmark dealers are doing more and better and different to the rest of the industry. So that's the agenda for the hour. We'll get through it, I think relatively well. And to start with, as I mentioned, I sort of just wanted to take that macro view of the world before we get more and more granular through the session. So it's changing. We know that the pace of change is as fast as it's ever been before. We sort of wanted to touch on these 6 macro changes that are happening right now. Record volume, but changing segments within that volume. Crazy levels of brand competition. New entrants obviously is on the tip of everyone's lips. The transition to electrification, what does that mean practically playing out? The evolving expectations of our customers, and then we'll deep dive specifically on the varying levels of dealership profitability. So record volume, so the 30,000 foot view of that record volume that we saw last year, and it looks relatively consistent for this year. Volume over the last 20-25 years has really tracked relatively in line with population growth. We are a stable political market, we're a mature market, and the growth of the automotive industry is in line with the growth of the population of Australia. And when I say a mature market, you can see here of those large automotive markets, we are the second most mature, you could say, behind the United States, nearly 800 vehicles sold for every 1,000 population in Australia. So a mature and stable market, and maybe at first glance at the 30,000 foot view, you might say, same. But Andrew, I'll bring you into the conversation now, and when we peel back the layers, not everything's as it seems.
Yeah, exactly, Lee. It's really interesting. Good morning, everybody, and it's fascinating the changes within the industry and the shifts between the segments. They're very, very significant. If we look back to 2010, 60% of the vehicles sold were passenger vehicles, Corollas, small hatches, sedans. That has shifted dramatically. It's changed across the globe, but probably more so in Australia, to a point now in 2025, over 80% of vehicles sold are SUVs and pickups, and those smaller passenger vehicles are making up only 14% of the total market. Now, Lee, what's interesting, we've overlaid this with our profit focus data. I think this is where really the hits the road for this industry, for dealerships, for brands, is that changing type of vehicle means that the average price of sale has gone up significantly. If we look at 2018, 2019, sort of $35,000, $37,000 was the average price of sale of the vehicles coming through Deloitte Profit Focus. We fast forward now to the midpoint of 2025, it's over $50,000, the average selling price of a vehicle, $53,000 there for Q2 2025, up 40%. Now, this is really good from a growth perspective. If we think about record volume in sales at $50,000 versus less than $40,000 a car, the average Australian is spending a lot more on their motor vehicles, Lee, which I think is really fascinating.
Yeah, absolutely. And then some on this call might have seen us present just a view of the crazy levels of brand competition at the moment. It's interesting. We've done a bit of digging into the VFAX numbers. If you have a look at what is the most competitive market in the world, these 6 brands that will flash up to start with, these 6 brands in 2024 sold 54% of the new vehicles in the market. Interestingly, if we have a look at H1 2025, these 6 brands sold 54% of the new vehicle volume. So there's a lot of craziness and a lot of changing, competitive nature of the industry. But these 6 brands are holding quite true at 54% of the market. These 14 brands on your screen at the moment are at about 82% of the market. That real, intense competition around that big chunk of market share around, let's call it at 80% for ease today. Then we roll to the 72 brands that were in operation in 2024 that sold the record 1.22 million units. So 72 brands plus then now the 8 brands that have joined the market in 2025. And my final build up here is the additional 20 brands that have identified the Australian market as one that they want to enter in the next 2 to 5 years. Now, some of them might not, others probably will. And we're racing towards, here in Australia, a potential 100 brand market selling 1.2 or 1.3 million units. So I think we all know, but this is a nice way to visualize just how competitive the market is here in the Australian market. We've tried to then have a look at the concept of the emerging brands and how that has looked over time. We've had a look at the digital version of the last 20 years. We've brushed off some of the old VFAX numbers and data from the last 50 years we've now got. So 50 years of market share data from 76 through to 2025. And you can see here, this is the American Australian, the Holden, the Ford. There's still the Ford and the Jeep and a few others that are here in 2025. But this is the movement of those American-based and Australian iconic brands through that 50 years. The next layer is the Japanese brands. So this is 50 years of basically being close to 50% of the market share for the Japanese brands here in the Australian market. The next layer is the German brands and really their height of prominence through the sort of early to mid 2000s. The Koreans came in a weight of numbers just before 2000 and have held relatively strong. And then obviously the latest trend is this emergence of Chinese brands and I think 16% market share last year. It'll finish the year a little bit more than that. But interesting to see those white columns come through in the last 4 or 5 years and to prominence in the last couple of years with just some bits and bobs making up the 100% of market share. So 50 years of market share. Emerging brands are nothing new for this market, but something that we all need to make sure that we're across and have a strategy as to how to take advantage of the shift in where those brands are coming from and what that means for us as dealers.
Yeah, it's interesting, Lee, when we have a look at it in a bit more detail. Like we think about those Chinese brands selling around 140,000 units in 2024. They're tracking more towards 180, 190,000 plus perhaps in 2025. It's interesting when you break it down and look at some of the top performers. We can see there BYD has really ramped up in the last 18 months or so, that using new energies to drive to the market. Chery rising rapidly, lower priced vehicles, and GWM, I guess, a mix of new energy type vehicles and traditional good value vehicles as well. We can see though some of those brands, as they get towards 5%, they're having a few challenges. So it'll be interesting to see what the pace will be of these emerging brands as they get towards 5% and beyond that, and what change they make to the market. If you flick to the next one, Lee, and I guess where the challenge is for some of those brands is looking at the different segments. So if we look at country of origin, the chart on the right there, you can see that in small SUV and passenger segments, China has had much greater impact and much greater share, 20% of the small SUV market and 16% of the passenger market. However, when we have a look at SUV large and the pickup space, that falls below 10%, a little bit over 10% for the SUV medium space at 12% there. But if you think about this market, we like driving big SUVs, we like driving big pickups, and those types of vehicles make up 62% of the total market. So at this stage, the Chinese brands have been stronger in those smaller segments, but our traditional Aussie favourites have still remained strong in the larger segments, as you can see there. So let's jump ahead again, Lee, to the next element that I guess is really interesting and is a bit of crystal balling, that transition to electrification. There's obviously a lot of movement in that space. We've seen it sort of stagnate for a period in terms of that market share around 8-9%. The last couple of months, though, we've seen it lift up, and last month EVs made up 15% of the market. I guess the question is, what will NVES do from a BEV and PHEV perspective? And there's a few factors that will sort of impact fuel types going into 2025. Will there be that continued positive impact of the government incentives on BEV? What will be the capability of some of the emerging brands to get price parity for technology such as PHEV? Will there continue to be a widespread availability of hybrid technology, as we see with Toyota at a price parity to ICE vehicles? And then what will be the ability of those traditional brands to sufficiently reduce or absorb NVES penalties without having an increased EV split. So I think what's interesting here, Lee, is what's going to be that most attainable way for those traditional brands to avoid NVES penalties. We've had a look at some of the shifts. We think hybrid will be pretty strong. We're probably looking at EVs, BEV and PHEV being between sort of 25%, potentially up to 34%. This is our high scenario that we show here. And under this scenario, what we envisage is those mainstream brands really looking to push their NVES penalties. We've done some calculators below $2,000 to $3,000 per unit. To do that, some of those key brands will need to have 10 to 20% share of their volume BEV and PHEV, as well as a lot of hybrid. A big driver of that will be the emerging brands continuing to have that sort of rapid EV growth. You can see BYD there, perhaps over 70,000 units, and more of those Chinese brands around 15, 20, 30,000 units, pushing up that EV. This is a high scenario. We think it'll finish somewhere between sort of 25 to 34% out to 2030. Thanks, Lee. It's interesting, though, we look at why consumers are moving to EVs. There's a few on this list here, but there's a couple that stands out, and it really comes back to cost. People that are interested in EVs, they're looking at lower fuel costs, they're looking at lower maintenance, and government stimulus is important. But those that are concerned, they're worried about that cost price premium and the cost of replacing batteries. So cost is still a big factor from an EV space. But it's interesting, though, when we look at charging, it's shifting a little bit there. A lot of people talk about public charging, but Deloitte studies have shown continuously over the last 5 years that most Australians believe they'll charge at home and at work. In fact, in our most recent study, almost 90% believe they would charge at home and at work, and many are capitalising on solar. We do see a higher level of EV uptake where there is also a higher level of solar panels at home. So interesting in that EV space and an area to watch. Thanks, Lee.
This is from our Deloitte consumer study. Just wanted to show a couple of slides on the evolving expectations of our customers. This is again from our consumer study that we do annually. I mentioned there loyalty is not what it used to be. I'll have a look at the far left one. We asked the question of our study, the percentage of consumers intending to switch to another brand for their next vehicle. And you can see there through the last 5 years, the last 12 months have been the highest rate of potentially looking to switch brands for their next vehicle. So potentially that shows us that there's maybe not a declining loyalty, but a change in what matters when consumers are thinking about loyalty. Interestingly, the middle slide there, the baby boomers are more loyal, and the younger that each of those customer segments gets, maybe the less loyal they are. So it's interesting, I think, to put some data behind maybe what we all know when we're interacting with customers every day, but I think it shows it through this consumer survey that we've seen. So we say that loyalty is not what it used to be, but maybe it's just different. I'm going to point your attention to those middle two. So we've asked, what is the importance of the sales experience to buying a car from the same brand? And what is the importance of the service and ownership experience of buying that car from the same brands? And it's interestingly that the point of sale is becoming less important to drive loyalty, but the experience of the ownership and the service and that continued relationship with the dealership is more important than ever. So interesting to see just how, what makes up loyalty and how that is shifting over time. So look, those are the sort of five big factors, and then the sixth factor we're going to dive into now, which is the varying levels of dealership profit, which I think is really important and what we wanted to widely share with the audience today. So let's have a look at now what the profit focus data is telling us. This quote, I won't read it out, but it will become, you'll understand the connection when we have a look at what is 30 years of dealer profitability. Many might, again, have seen this slide. This is the collection of the average profit bottom line for the average dealer as a percentage of the total top line profit. So your net profit as a percentage of sales for the average dealer across 2,000 reporting dealers for 30 years. So 1997 and 2025 are the two bookends. And you can see there some really important moments in time, right? Around 1.5% bottom line for that first sort of 10 years. You can see in the middle of your page the dip for the GFC, the spike pre-COVID to 2.5% bottom line for the average dealer, driven by vehicle volume, driven by the golden age of finance and insurance. We can see, and I'm sure many on this call would have felt that those few years just before COVID, 2018, 2019, the average dealer was 0.5%. 35% of dealers were losing money. That's 1,000 dealers were losing money. Then COVID happened. So you can see the spike of the COVID period, but then you can see where we are, and an important discussion today, we're back down to that 1.5% bottom line for the average dealer. So a lot of different ways to commentate that. We sort of had a look at that 30 years and said, hey, that 1.5% that we've just experienced in the last 6 months, it's actually consistent and really the line of best fit for this industry for 30 years. So, we've talked a lot about the last 6 months and the next 6 months being a critical inflection point for this industry to really understand where that little white squiggly line is going to rest at for the next few years. But this industry has always been a 1.5% bottom line industry. We had the GFC, we had oversupply, we had COVID, but actually, if we do this and if we look at it, objectively, it's a 1.5% industry. And I think we've got the chance to really create that over the next couple of years as an industry and as a bunch of dealers. So 1.5%, we look at that for a little bit of consistency for the 30 years. We always get asked, though, is that good? No one's learned. OEMs look at dealers. Have you learned? Dealers look at OEMs. Have you learned anything from that COVID period? And if we have a look at how that 1.5% comes about, I think the answer to all those questions is, yeah, we have. We've learned a lot as an industry. So this is those 4 spots that I talked about, the 1.5%, 2002, 2008, 2017, and 2025. And this is the summation of the selling gross and the fixed expenses at each of those points where the industry was 1.5% bottom line. And you can see there, if we ask the question, have we learned anything from COVID? Have we learned anything from before COVID? We as an industry are 35% better than we were 7 years ago. The problem is we're 33% more expensive to open the doors every day. So are we better? Have we learnt anything? Are things different? Or are we just a 1.5% bottom line industry? Our answer is yes, we're better. Yes, we've learnt a lot. Yes, we're doing things differently. We're 35% more gross pool and selling gross pool than we were only 7 years ago. Interestingly, I don't have it on the slide, we're 70% better than where we were 20 years ago, but we're 65% more expensive also than where we were 20 years ago. So we are getting better, but things are getting more expensive. When we get into the cost structure, I'm going to break that down a little bit more a little bit later to understand whether that explosion in cost is good or bad or indifferent. But I do want to make sure that we can have a look at that 1.5% bottom line and actually treat it with a bit of, I don't know, good grace, I suppose, that it's a strong performance against where we've come from. We're just battling a lot of cost pressures that we'll break down a little bit as we go forward.
And Lee, just to add to that cost pressure point in there, that new vehicle gross number includes a much higher interest rate floor plan cost than we've had in the past as well, which again, we'll break down that in a lot of detail for you in a moment.
Yeah, absolutely. So the good news, and Andrew alluded to it a little bit earlier, 1.5% of a bigger pie is driving a bigger profitability. So again, 02, 08, 17, and 25, the industry hit 1.5% bottom line for the average dealer. But what we're selling is more expensive. Our top line revenue is growing. Big groups are getting bigger. And so 1.5% of that bigger pie is driving stronger profit levels in terms of dollars that you take home over the last 20 years. So that's the average dealers' average profitability for a month during the first half of 2025. And how's that being driven? So this is selling gross. So we looked at the selling gross pool at a point in time over those few years. This is how it's changed over time. So as you can see, the selling gross pool for the average dealer went up 127%. The good news is we've been able to keep most of that, and Andrew's going to break that down in a moment, but it has subsided back down 28%. When we break that into which department is adding up to those gross pools, we can have a look here that the back end, those bottom two dark greens on the bottom, the back end has really been slowly building strongly and nicely over the last 6 or 7 years for the average dealer, up 20% in the last 7 years. The used and finance departments for the average dealer has been growing 15% in the last 7 years. So the core operations, the underlying operations of the average dealer in the Australian automotive industry is really strong. We've obviously ridden the wave of the front end, and now how much of that wave can we keep going forward to make sure that we don't get squeezed too much over the next couple of years. But interesting to see those core operations of parts, service, used vehicles and finance being strong, holding up well and growing over that period that we're looking at. Another different way to have a look at that 1.5%. So we've had a few different cuts of the 30 years of that data. And it's always coming out to a mathematical 1.5% bottom line. We just want to sort of explore and dive a little bit deeper into what does that mean and what's really happening in the industry. So this is 2002, 1.5% bottom line. On the left axis is lost dealers that are losing money. On the right axis or the right-hand side of the axis is dealers that are making money. And the vertical is those size of those dealers. So these are the reporting dealers in 2002, all huddled around that 1.5%, delivering an industry average of 1.5. If we have a look at 2008, you can see the scatter graph is starting to really disperse out more and more. If we have a look at 2017 and then roll forward to 2025, throughout that period and throughout the last 30 years, the average dealer line of best fit has been 1.5% bottom line, but the dispersion of performance that is driving that is getting larger and more varied. Here's a nicer one-pager to have a look at how the dispersion of the automotive industry in Australia is taking place. So you can see there, 20 years ago, most dealers were nestled around that 1.5. 2025, it's more just a mathematical average of that dispersion of performance amongst the dealers. Andrew.
Now, Lee, I know you're very visual, and this picture tells 1,000 words, and you can really see that dispersion. But we thought we'd double check the numbers. So if you flick to the next slide, Lee, you can see when we look at three core groups, that average dealer in the middle there peaking at 4.5%, then dropping down to the 1.5% for Q2 2025. We've got on here, the green line is the benchmark dealer, the top 30% sitting at 4.4%. But then we've got the grey line down the bottom 30% that has dipped below that 0 point, sitting at minus 1.2%. And for Q2 2025, that spread is 5.6%. That's the biggest level of dispersion between the bottom 30 and the top 30 that we've seen. So the night sky, Lee, tells a story, but I think the numbers here reinforce that story as well. Dispersion is growing across the industry.
Yeah, and I think that speaks to one of the key messages that we want to get out today is there's a lot of money to be made in this industry, but there are also a lot of challenges that we need to navigate. And I think a graph like this shows that quite well. One of the other unique ways that we've tried to cut the data is to try to answer the question of, does size matter when we're having a look at dealership operations? Probably our original hypothesis was that it might be better to be bigger, and then you get more vehicle volume through the top of the funnel, or it might be better to be smaller so that you pay a lower rental factor on your fixed cost line. We've run the numbers and corroborated this with what's happening in the market. And actually the answer is it's not necessarily better to have more size, or more scale. And there's a lot of different factors that go into dealership performance. So on the left is size, that's revenue per month. So 0 to 1 million turnover, 1 to 3, 3 to 7, and 7 and above for a roof or a brand's retail point. And you can see there that the average performance is somewhere between 1.5% and 2%. So not really trending to better being bigger or better being smaller. And then on the right, it's the ownership group. So that site or that profit that a dealer is making, and how many roofs does that group own? Is it a standalone family group, 2 to 9 roofs, 10 to 49, and 50 and above? And once again, really not showing us a trend that it's better to be bigger or have more scale, or smaller and be more nimble. What it probably speaks to, and quite nicely aligns with the key messaging of today, is it's not size or scale, it's operational performance. Operational excellence is what drives profit and benchmark performance levels, not necessarily your brand or your size or your scale. So I think that's an important takeaway as well, is most dealers, all dealers out there can hopefully get to benchmark levels of performance, not necessarily hamstrung by your size or scale. So with that, as we go through some of the operational stuff, I'll hand to Andrew in a moment. We're going to take you through and build this up as we go. 10 targets that hopefully should matter to you and to the network in 2026. So we're going to build this up as we go and through each department. But I think this is an important little checklist. To Ashley's point earlier, we're going to send these slides out. It'd be great to have a look at where you compare against some of these targets that we're going to go through today. If the targets aren't quite right for your business, you can navigate them a little bit and change them as you need. But I think it would be nice to just assess where your dealership or your group sits against some of these targets that we're going to take you through as we get a little bit operational over the next sort of 20 minutes. So Andrew, with that, as I mentioned up front, we're going to walk through each of the departments of the average dealer and have a look at what that is telling us and some of the benchmarks that are coming out of that. So I'll pass to you, mate.
Yeah, thanks, Lee. And we'll jump into each department. I guess the key opportunity here is let's have a look at how the average and the benchmark has shifted over the last sort of 5 years, comparing 2025 back to 2018 and 2019, and what are some of the key opportunities and challenges and insights that we can take out from that data that you can take back to your dealership and work with your team on. So I'll start with the new vehicle department. I think what's really interesting here, we start with inventory on hand, and coming back to Lee, you mentioned earlier, we get asked, have we learned as an industry? If we have a look back in 2018 and 2019, the average dealer reporting to Deloitte, so on average, a multi-franchise dealer, 2.5 to 3 brands, had around 220, 215 vehicles in stock. We go through that COVID period where there was no supply, it dropped down to around 100, which we call net zero. Every vehicle there showing in dealer stock was either going through PD, was a test drive demonstrator, was a service loan vehicle, had a customer name on it. We then saw into 2023 and 2024 stock starting to come back. Now, particularly if we have a look at sort of the second half of 2023, I guess when we were talking from a Deloitte perspective, we were thinking that stock was really going to start to build up and perhaps get ahead of that 2018 level. But we can see the lessons that have been learned, and stock has steadied off even in the back half of 2024 when volume was under a bit of pressure. And we see now Q2 2025, the average dealer holding 210 units in stock. But if we think about it, we just had a record year. The first half of 2025 is ahead of the first half of 2024 from a volume perspective. That day's supply is at 62 days supply, which is well below the 70 days that it was at in 2018. Now, the good thing there with that stock being tighter, if we flick to the next slide, Lee, is that it's supporting gross profit. So back in 2018, 2019, the average dealer was making around $2,500 per new vehicle. That peaked at close to $6,000 in the middle of 2022 with that stock shortage. As stocks started to come back through 2023, through 2024, as we expect, grosses came down, but they came down a little bit. they've actually been holding pretty well, fairly steady. And we see now Q2 2025, the average dealer's average gross is $4,223, including a holdback, including incentives, far ahead of where it was $2,500 back in 2019. So we're hopeful that dealers can maintain this position. Even if we look at July and August and we haven't got the quarterly bonuses coming in there, it's only gone just below $4,000. So it's quite pleasing that we've been able to steady that new vehicle gross profit, which is very important in terms of holding up this profitability. Have a look at the next slide. I guess one of the big impacts, though, against grosses on our vehicles is that floor plan expense. So we can see back in 2018, 2019, the average dealer's floor plan was around $350 to $400 a car, when interest rates on stock was around 4%. What we've seen though is that stock levels gone back over 200. We're now playing in a space where interest rates are around 8%. And we can see there, the middle of 2024, the average dealer floor plan was costing almost $900 per unit sold. Pleasingly, we're seeing that steady stock level, and we're starting to see the RBA reduce interest rates. And for Q2 2025, it's down to almost $700 per unit. Hopefully that number, Lee, will continue to go down. I guess that's in the hands of the Reserve Bank. We're hoping that there's another $100, $150 plus relief over the coming 6 months or so in terms of floor plan expense per unit. But what does that mean from a selling gross perspective, Lee? If we have a look at the next slide, this is where it's quite interesting. Now, yes, selling gross peaked at over $3,000 a car for the average dealer in 2022. Back in 2018, 2019, it was almost zero. Our semi-fixed and variable expenses to sell a car matched the gross. If we fast forward now, yes, we're still seeing that decline in new vehicle gross, but the decline in floor plan expense has meant that selling expenses are also reversing. And actually in Q2 2025, we've seen selling gross start to come back up. The average dealer making almost $1,300 a car in selling gross. Yes, not as high as the heady days during COVID, but well ahead of that sort of couple of $100 a vehicle selling gross that we saw back in 2018, 2019. A real key to profitability. An interesting thing amongst this, if we have a look at the semi-fixed expenses on the next slide, Lee, you can see, yep, floor plan is a big chunk there. But another big chunk is those bottom two areas, our salesperson and sales manager salaries per unit. And one of the key things that we see benchmark dealers do is reduce this expense per unit, this salary per unit. They do this through high productivity. You see on the next slide, we look at productivity per salesperson. And across the industry, for the last 5-10 years, it's sat around 10, 11, maybe 12 units per salesperson sold. Benchmark dealers have been able to push up more towards 15 plus. You can see a peak there of almost 19 units sold per dealer. This is a really key element. What we find is if you get your salesperson units sold per month up around 15 to 16, that creates a couple of $100 savings in selling expense, but it also means that the salespeople are earning more. So it starts to help retention. Right? And if you're not losing salespeople, you can keep that average unit sold per salesperson up and keep that selling expense down. So productivity really is a key thing that helps set benchmark dealers apart. So Lee, let's jump into our first set of those 10 targets.
Yeah, so we wanted to put a few for the new vehicle one. So a little bit of a, let's see which ones. So the 0, the 20, the 30, and the 100. So the 0%, a target should be 0% non-responded customer inquiry leads. I know that's a bit of a struggle for many of the dealers that I've been working with lately. If we can really target 0% non-responded customer inquiry leads, it'll go a long way to getting that productivity number up, as Andrew was talking about. We've got to start integrating AI. So maybe 10, 20, depending on how mature you are on the AI curve, AI-enabled customer engagement. Start testing and start learning how you can integrate that technology into your business. Hopefully 30% sales from returning customers, probably depending on your PMA and depending on your brand. I think 30% feels like a relatively aspirational target for most, and really build that loyalty and trust into your customer base of your new vehicle department. And then the bottom one there, 100%, hopefully 100% constructive relationships with your represented brands in hopefully a symbiotic relationship between you and the brand that you represent, and hopefully vice versa. So there's 4 out of the 10 that we're going through that relate to the new vehicle department. Andrew.
Yeah, I was just going to add, I think those first 3 are really important from a conversion point of view. If our team can really maximise the work they're doing with the leads that they have, enhance that conversion, we see that as being a core element of driving that 15 plus units sold per salesperson. So some big opportunities there for sure.
Yeah, which will drop the selling expenses, which will increase the selling gross, that drops to the bottom line, and the whole thing just starts to hum. So yep, absolutely. Yep. Used vehicles, Andrew.
Yeah, used vehicles is really interesting, and I want to start with looking at the average sales price, and I think this is where the opportunity is coming from a used vehicle point of view. We see it peak there in the middle of COVID at around $30,000 per average vehicle, up from around $20,000. At that point, it was really hard to get stock for dealers. Grosses were still strong, but it was hard to get units through. You couldn't trade in, you had to buy at high prices or buy at auctions. What we started to see through 2024 as that price dropped is dealers were able to buy better. They were able to trade in vehicles. It was harder for customers to sell private to private, and they could buy better vehicles from private customers as well, reaching out to those private customers. So Lee, we're seeing that flattening of the average selling price is actually translating positively from a gross point of view. So yes, it's down from the heady days, but the last 4 quarters, we're starting to see an increase in gross. And this is based on dealers being able to buy vehicles better. We're able to trade in more vehicles. We're increasing the percentage of trade-ins and able to buy better privately. What's really positive here is that increase in the selling gross. You can see there for Q2 2025, almost $700 per unit in selling gross for a retailed vehicle. You add on top of that $600 or $700 going through the service department in terms of reco, and it's actually a KPI that we've seen strengthen throughout the first couple of months of Q3 through July, August. It's that selling gross has pushed close to $1,000 per unit. It's an area, Lee, that we see on the next chart where benchmark dealers again do very well. They buy in their stock well. It helps drive grosses. They have good productivity from the used vehicle teams, and we're seeing benchmark dealers pushing selling gross well above $1,000 per unit. So we think used vehicles is a really good opportunity for dealers to push harder in. Not only work your sales department from a trade-in point of view, looking at buying opportunities, but also work your service department. How can we buy in more used vehicles from service customers as well, that hopefully translate into a new vehicle sale? If we have a look at the used to new ratio, it's probably the area though that is still fairly flat. We're struggling to increase that used to new ratio, but you can see there the top performers are consistently pushing around that 1-to-1 mark. They're able to trade in more vehicles, buy more vehicles as well to get that 1-to-1 mark at a strong selling gross position, which is really helping profitability because you don't tend to grow your fixed expenses as you grow your used vehicle business. So a big opportunity there, Lee, that you're going to talk about a little bit more later. So if we jump back into our 10 targets that should matter in 2026, we really want dealers to be looking at that 70% used to new vehicles sales volume ratio, pushing towards that benchmark dealer position of 90%, but a minimum target rather than being just 0.5 used to new. Let's really target that 0.7, that 70% used vehicles as a percentage of new vehicles sold. And I think it segues nicely into finance as well. If we can capture more customers back through finance, hopefully we get more of those used vehicle trades also. So finance is an interesting one. We sort of saw that steady position over the years where the average dealer was having a penetration rate of around 30%. It got to 34% just at the beginning of COVID, but we saw with those long delivery lead times with increases in interest rates, finance dropped off. And we'll show in a moment it's an area of great dispersion. And with those challenges, many dealers found it difficult to penetrate, above 25%. And it got as low as 22% at the back end of 2023. As stock came back, we started to see more OEM finance campaigns, and we saw that penetration number go up. Now, that also impacted, though, the dollar per contract, as many of those campaigns were subvented. However, even though the dollar per contract was reduced, one thing we always see with finance penetration is the higher the penetration, it always generally results in a higher finance income per retail unit sold. And you can see there, Q3 2024, when that finance penetration reached a maximum of 31%, we saw that income per retail unit lift above $800. With penetration dropping off over the last few quarters, that retail per unit has also dropped off. So penetration presents great opportunities, not only more pool of gross for you as a dealer, but some studies that we've undertaken identify that the finance customer is 2.1 times more likely to repurchase from the dealership as well. So we see some great opportunity in finance in terms of repurchase customers, but also taking a bit of pressure off that front end gross to help us hold around that $4,000 mark in terms of new vehicle gross. So looking to the next slide, this is the scatter graph again. So the night sky telling us the story again. We can see there that average penetration rate, zero penetration being at the bottom of this chart here, and 50% penetration being at the top of this chart. And we can just see how scattered it is with dealers across every element. There's not even a consistent sort of spot, but it identifies that 50% is an achievable number in terms of finance penetration. So Lee, if we jump into our 10 targets, we are setting a pretty lofty target for finance penetration. We think dealers should really start to be thinking about how do we get our business up to 50% finance penetration. Obviously, stage your way there, but we think 50% is achievable. Dealers that really focus on this area, that link in well with their sales team to get those early introductions, that have a good range of finance offerings and providers to support getting different customers set, are able to get themselves up closer to 50%. So Lee, it's a big target, but we'd like to see dealers pushing more towards 50%. Great for retention and great for driving up that pool of gross.
Absolutely.
Let's jump into after sales. So Lee, you touched on before that we have seen growth in the after sales space. And we'll start with service. We can see here as we got techs back from being away from COVID, as we've been able to get techs back from overseas, we've been able to capitalise on the retail opportunities. And we've seen a 30% increase in total service sales. There's still capacity challenges. Retail sales are up 20%, but sublet sales are up 75%. So we're having to sublet more of our services out. So capacity is still a challenge that also impacts efficiency. So how can we drive up the capacity within our individual dealerships by getting more efficient operations? So that increase in revenue, if we flick to the next slide, has also provided an increase in gross profit, up 22% on where we were in 2018. So we're seeing better retention of customers through cap price service, driving up more sales revenue and more gross profit through the service department. But it's not just service that has grown. That growth in service has obviously corresponded to a growth in parts, particularly in the workshop space. You can see there, workshop parts are up 25%. We've also seen a lift in wholesale parts as well, up 35%. So it wasn't just our workshops that were affected by lack of staff. We've also seen panel shops and independent repairers able to get more staff back in, increase their available hours, and then buy more parts from us. So if we look at the service and parts revenue as a whole, you can see there for the average dealer from under $1 million a month to $1.25 million a month, 30% increase, almost $300,000 increase in revenue for the average dealer, which has driven an overall gross increase of over $100,000. Almost $100,000, a 25% increase in gross coming from the back end of the business, which is important because if we have a look at service and parts absorption, it's been under pressure. I've just had the good news story of all that growth in the after sales space, but unfortunately, Lee, it hasn't kept up with the growth in fixed expenses and that floor plan growth. But it is very pleasing to see the last 2 quarters, we're getting closer to 50% in terms of our service and parts absorption. It is an area with a strong back end and good fixed expense control that benchmark dealers have been strong at and have actually lifted above 60% for the most recent quarter. So if we have a look at those 10 targets, there's some interesting ones here. So in terms of service and parts absorption, we really want to push high. We want to get above 60% like the benchmark deals. But I think one of the key call outs to help really drive up that service and parts gross profit is a big focus on that first service retention. Yes, we're suggesting 90% for first service 12-month retention rates. What you find is that's the easiest point to hold the customer, and the tail stays high. If you're down at 70%, after 5 years, you'll be about 25% retention. The benchmark deals that get to 90% are almost 60% retention after 5 years. We've done some maths for a dealer selling 40 units a month. That's over $500,000 in additional service gross from keeping more of those customers. And the last key point there in terms of retaining more of those customers, our studies have identified that a service customer is 2.6 times more likely to repurchase. So your service department, as you touched on earlier, Lee, is a great avenue for future sales as well.
Beautiful. So that's a lot of data and a lot of KPIs. To Ashley's point, we're going to be able to send this through. So it will be a good chance to be able to digest that, maybe on your next plane trip or on your couch at night, one night, just to work through some of those data slides from your core operations, and then try to tick yourself off against some of these targets. So as Andrew mentioned, that pool of gross and that retention play is super important. We've just done a little exercise, and again, something that we might want to try to do for you in your businesses. H1 2025, approximately 600,000 new vehicle units. As per AutoGrab, about 1.1 million used vehicle units. That there was a pool of available new vehicles sold that we could have sold finance to, and then approximately 11 million services done, not in franchise, but in total industry, in total market, about 11 million retail services done during that period. Let me make all those balls the same size, and then have a look at how we as an industry tracked against each of them. So if we start that top of the funnel, let's say that is our market share, 600,000 new vehicle units sold. About 27% of the available used vehicle market was sold through franchise dealerships during that period. So Andrew showed a 0.5 used to new ratio. We sold 300,000 used vehicles out of a total pool of 1.1 through franchise dealer network. Out of 600,000 new vehicles sold, we sold finance to 28% of those through our franchise dealerships. So about a 28% coverage of that available market. And then about 5.7 million retail services done through the franchise dealer network in the first 6 months. So about, let's call it 50-50. So it's a nice just way to visualize, if we say that the top of the funnel is the top of the funnel, how we went against the maximum available market. And it would be interesting to track your dealership against that, and then track over time whether you're able to get more and more of that available market coming to your dealership and buying your services and your product. But an interesting assessment of franchise dealership performance in the total available market for the first 6 months this year. So then that leads us into expense structures. So Andrew talked about that when we talked about service and parts absorption. And let's have a look at what is happening with the cost of our business and the cost structure of an average dealer. I won't go too much into that now. We're a little bit up against time, Ash, but we're going okay, I think. So interesting to see how the dealership landscape is evolving. We've gone and mapped all 3,320 dealerships. So your far left there, 3,320 rooftops of franchise dealers operating in the country. Interesting to see that second one, how the shift in ownership groups is playing out over the last 5, 6, 7 years, and how on those far right, the top 20 groups, so those larger groups in the industry, continue to get bigger and bigger. And now 20 groups own 35% of the rooftops in Australia. We then broke that down a little bit even further to have a look at how the movement in rooftops owned is going over time from the standalone groups to the large, significant, maybe listed players on the far right, and interesting to see how that shift of those sort of small to medium family groups, that second graph there is really the group that hasn't moved much in the last couple of years. And that's probably the one that I'm most interested to see how that plays out over the next 5 years, but interesting to see how each segment has sort of evolved since 2018. This is something that we'll keep tracking going forward every at least couple of years, just to see how the ownership model is evolving in the industry. So some interesting stats there. So then if we have a look at the fixed cost base of those average dealers, so whether you're small, big, large, let's just have a look at the average dealer through the profit focus reporting. This is the fixed cost and how that's moved over time since 2018. And you can see there a 45% increase in fixed cost in just 7 or 8 years. The good news is the average dealer has got ahead of this now and has been able to just squeeze that average fixed cost of operating a dealership. That's come down in the last sort of 12 months by 10%. So it's good news that we're not continuing that cost explosion. Similar when we add the semi-fixed costs to that. So fixed costs and that semi-fixed costs, sort of 40% up and nearly a 10% squeeze. So that last 12 months of movement of how we've tried to fight against inflationary pressures is really pleasing, that the average dealer has been able to understand the explosion and try to manage it effectively. And then this is the key, and this is sort of the structuring that we like to make sure that you're having a bit of an assessment with internally. This is your fixed cost base as a percentage of your total pool of gross, your total gross pool in your dealership. And the number for the average dealer is sort of, let's call it 45 to 50. But the benchmark dealer for the last 7 years, most of the time, most of the quarters, has been able to keep their fixed costs as a percentage of gross under 40%. So if you can get that 40% seems to be a bit of a magical number. If you can get your fixed costs under 40% of your total gross, that's a cost management exercise. It's also a gross increase exercise, so both at the same time. But that 40% seems to be a bit of a magical number to structure your business. So we have to look at then, is that increase in fixed cost good or bad? It's probably a little bit hard to tell. We've gone back. This is a really interesting exercise. We've gone back 25 years to have a look at how, on the right-hand side, the green, how the fixed cost increase of an average dealer has increased. How much? 118% during that time. Let's call that basically it's doubled. And then on the left, we've checked that against the cumulative CPI in the general market, the cost of petrol, the cost of coffee, the cost of goods and services, 103%. Basically, the cost of goods and services and the cost of opening your doors every day in the average dealership have basically doubled in the last 25 years. So the cost increase that I talked about 45 minutes ago, yes, we've done great. Yes, we're improving, but yes, we've had to, because we've had to pay for ourselves. We've just triple checked that against CPI, and we're basically in line with inflationary pressures in the general economy here in Australia. We've gone a little bit more granular than that and had a look just for that last sort of 6 or 7 year period that we've really been analysing, to have a look at the white line, how CPI has changed over time, and the green line, how the fixed costs in a dealership has changed over time. And I think it's interesting to see 2021, 22, 23, the industry was making a lot of money during that COVID period, and the costs increased at a faster rate than CPI. So that bad habits, good times. But then pleasingly, if you have a look at since COVID, when there's been some real pressures in the industry around margins and costs, 2024 and 2025, the average dealer has been able to squeeze fixed costs at a better rate than CPI. So that's the good habits, bad times. So this graph, almost the last two graphs, has the cost explosion been in line or out of line with general economy? Tick, tick. I think we can say most things are twice as expensive as they were. 25 years ago, including running a dealership. And then if we take that one step further, and that old adage of good habits, bad times, bad habits, good times. So hopefully we can get ahead of that curve and continue to have that green line under the white line over the next few years. So just a couple of interesting perspectives on that cost structure of an average dealer. And so the 10 targets, 3 around cost management. So the number there in the middle, that I'll go straight to the 40%, that seems to be the magic number, 40% fixed costs as a percentage of total gross. And then one step deeper, 10%, which is the rent factor as a percentage of gross. If you get those 2 right, your operations should be able to, if you're doing well, deliver a benchmark level of profitability. And then 80% staff retention on top of that. So that will be the 10. So we'll show you them in a moment. But then as I mentioned up front, we want to run now. And Andrew, I think we're doing okay for time. I want to run some scenarios. So what if we went down one path, or what if we are able to go down another path over the next few years to have a look at what that means for the average dealer profitability. So Andrew, I'll pass to you at this point to play this out, mate.
Yeah, so look, the team's done a fair bit of work, and we've built a very nifty scenario tool that we run through our dealer groups, we run through our dealer profit optimization program, and we're going to use this tool to have a look at, well, where are we now at that 1.5%, but where could we have been, right, if all things stayed true. So Lee, if you jump ahead a couple of slides. So what could have been true? I want to think of a couple of scenarios. We talked about inflation driving up fixed costs. So what if our fixed costs were exactly the same as what they were in 2019? You'll say that's unrealistic, yes, but what if they were? Our net profit, as at today, based on all other elements of the business being the same and fixed costs being what they were in 2019, the average dealer would be at 2.8% net profit instead of 1.5%. There's another little element there that we touched on, that increase in interest rates affecting our floor plan. What if our floor plan costs was that 383 that I showed you for 2019? The average dealer would be at 3.3% net profit. So that's the potential position. That shows that improvement in selling gross, that extra gross profit we've driven from new vehicles, that extra sales through after sales, that if we didn't have the macroeconomic factors of increased interest rates and increased inflation driving up fixed costs, driving up floor plan, the average dealer could be at 3.3% net profit return on sales. So a fair hypothetical, very positive. Lee, yeah. What's the flip side to that?
Well, I mean, are we better? Yes. Have we improved? Yes. But we've had to, because it's much more expensive. Play out the negative of Andrew's positive. What we hope isn't going to be true. So we've got the 1.5% that you're all familiar with now in this webinar. If Andrew's, what he showed as 4,200, the average gross margin on the new vehicle, if that dropped back to where it was in 2019, which remember it was $2,500 per unit, the average dealer would be in a loss position. So the positive is, apart from those cost pressures, we would be 3 and above. But if we go back to new vehicle gross where it was, we would be under 0. So there's the positive and the negative of how the last couple of years have played out, and where we find ourselves as an industry at the moment. So Andrew, what could be true?
What could be true? What are the little things that could help drive up profitability, and what does that look like in our scenario planner? So I talked earlier about the new vehicle gross being around $4,200 per unit, and I guess flattening off. So if we can keep it at $4,000 per unit, slowly coming down out to 2030, that would bring the net profit down to 1.2%. Now, our expectation is that interest rates will come down. We won't see this very high floor plan cost per unit forever. If that comes down by $250, we go from 1.5 to 1.4%. Our selling gross per new vehicle stays about the same. So we've got to reduce our floor plan costs, keep our gross at a similar level. If we can further increase those semi-fixed selling expenses by having more productivity from our salespeople, so at least 14 units per month, our average net profit goes from 1.5 now up to 1.9. So margins come down a little bit at 4,000, improved floor plan costs, improved our salesperson productivity. If we now improve that finance penetration, now maybe in this scenario plan we've gone a bit soft. We've said 32%. We set a target of 50, but let's go 32% plus those three other elements. That gets the average deal of the 2.1% net profit return on sales. If we look at our service gross margin, so we improve our efficiency and get our service gross margin up from around 62, 63% to around 65%. That improves the back end gross. That gets us from 1.5 to 2.2% return on sales. And then lastly, if we can have a bit more fixed expense control, CPI flattens out, continues to sort of drop off, get closer to sort of 1 to 2%, and dealers are able to reduce their fixed costs by 5% over 5 years, that would see us at a 2.5% net profit return on sales. So challenging things to do, but achievable things to get to a 2.5% return on sales, despite the challenging macroeconomic factors that we see in terms of it being more expensive to open our dealerships, Lee.
And Andrew, we should just call out at this point, this is not a forecast. What this is a set of steps and a set of actions and a set of targets that hopefully, you know, an average dealer can have a look at, trying to tinker with their business and really focusing on what matters most to drive profitability. And you can just see in this scenario with 5 or 6 little tweaks, you can get back to a business that's doing 2.5% bottom line, which if you take COVID out, that's the best that we've been as an industry in 30 years, excluding that COVID sugar hit. So few tweaks, underlying strength, you saw right up front, underlying strengths in the business, a few tweaks to what matters most and what drives profitability. And we're quite bullish about where this could get to. Having said that, we know that dispersion of performance is going to continue to get bigger and greater.
And Lee, it's fascinating when we use this scenario tool with individual dealers and help pinpoint the areas of opportunity and what that can mean from a profit point of view, how that helps get the team on board and focus on the task at hand to improve that pursuit of benchmark.
Absolutely. So we talk a lot about intent and intensity. So knowing what the benchmark is, knowing what the target is, knowing what the actions that should drive that target are, and then just going hell for leather, running it at 1,000,000 miles an hour, but really focusing in on not running at 1,000 things, but running on 5, running at 10, running at a set number of KPIs and actions that are really going to drive performance with the intent and intensity that it takes to drive them forward. So we talked the 10 targets that matter. I'll just quickly go through them, but you'll get a copy of these. 0% non-responded customer inquiry leads, 10% rent factor, 20% AI-enabled engagement with your customers, 30% loyalty of your new vehicle sales, 40% fixed costs as a percentage of total gross, 50% finance pen, 60% parts and service absorption. That's what benchmark dealers are doing at the moment. 70% used to new ratio, 80% staff retention, which really connects all of this together if you get your team right and trained and they stay with you to be able to deliver excellent performance. 90% first service retention and 100% constructive relationships with your represented brands. So Ash, one final slide before we pause for 5 minutes of questions. We always get asked, what are the traits of a benchmark dealer? I'll flip all of these up, and again, you can get a copy of these. We've got the 10 traits. Maybe the top 5 are a little bit more qualitative and the bottom 5 a little bit more quantitative. But I think it starts with a symbiotic relationship between a dealer and an OEM and vice versa. We talked about that employer of choice, that retention of good people, attracting better people. and really training them up to be awesome. Customer experience, we've touched on that a number of times over the last hour. We've talked about the integration of new and different technology that can hope drive not only cost savings, but hopefully productivity improvements. Top right, I think, is important. We could have almost started or ended with that one, which is I think leaders, DPs, GMs, owners seeing change as an opportunity, not necessarily a challenge, but an opportunity to do things different and better. Andrew, I don't know whether you want to take us through the bottom five.
Yeah, well, I think those bottom ones link in nicely. If you connected teams, I think that's a core driver of that customer experience, the employer of choice. If you can get your departments really well connected, your people are happier, and it gets a better outcome for customers. That then also drives that opportunity to get that value chain maximisation. We talked about the sales team working in with the finance department, the service department, getting that first service retention. That's on the sales team as well, obviously linking into service retention, which drives that back end and that service and parts absorption. Productivity intensity runs across the whole business and supports reducing those semi-fixed expenses, which obviously then having that optimal cost base, particularly rent, less than 10% as a percentage of gross, is a core driver of a benchmark position. But you can see how each of these 10 elements really do link in with others.
Cool. So we'll send around a copy of that. It's sort of how our business approaches this: consolidate and understand the data and what are the insights telling us. Focus on what elements of those operations are going to drive performance forward. Train and develop your people to be able to be good enough to execute on that. And then, as things are changing, make sure we've got one eye on the future, one eye very much on the customer in front of us, but one eye on the future to make sure that we sort of understand the strategy of what's next around the corner. So, ladies and gents, and Ash, pass back to you at this point. Thanks very much for joining. I don't know, I haven't followed the Q&A along. We're about up against it, but keen to see whether there's any questions or we can take anything offline if we need to.
Yeah, maybe I'll just do one quick one. Someone said on used cars, we're seeing the used EV market struggle in the face of weak consumer confidence, both privately and dealer. Do you think this is a missed opportunity for dealers, or is the risk still too much to take on?
I think the risk will be less into the future. If you think about people that are selling their vehicles, their EVs now and over the last year or two, purchase them pre the government incentive. So that has obviously pushed down the value of used vehicles. There's more models available now that are sort of $40,000 to $50,000. 3 or 4 years ago, everything was over $70,000. That's pushed down the value. I think we're going to see less of that change into the future in terms of the vehicles becoming cheaper, which means that I think we'll see EV residuals normalise a little bit. And perhaps it's an opportunity for dealers to buy some vehicles cheaper, and then perhaps the used vehicles still attract the novated lease within certain parameters. So they may be able to make some good margins on used EVs sold under a novated lease.
Yeah. And then one other, which you may have already answered, is we'd be interested to see how much of that 33% cost increase is energy supply, so like charging infrastructure or.
It's interesting. We always get asked, what are the elements that are driving that fixed cost? We've tried to have an interesting answer to that. Unfortunately, the answer is so boring. It is everything.
Yeah.
So it's energy, it's insurance, it's rent, it's technology, it's your DMS, it's people costs. Basically, as we've sort of tried to have shown, it's not an element of a changing model of operating your business. It is general inflationary pressures of the cost of doing business. So, Mark, I see it. Yes, it's definitely involved, but no more or less over-indexed than just general increases in costs throughout. So,
and perhaps just to add to that, with the high level of people planning to home and workplace charge, there may be less requirement for dealers to have a lot of fast charging infrastructure for consumers. They may not expect to have a fully charged vehicle when they receive it back, because they're simply charging at home quite conveniently.
Yeah.
Ash, do you mind if I just take one moment just to sort of, I suppose, closing comment? I think hopefully it showed through from the stories that we told and the data that we showed. The real intention when we had a look at analysing what half one looked like was that there was a bit of, I don't know, maybe negativity in the industry around the squeeze and profit, right? We had this crazy, unusual profitability period for the last couple of years, and then that was being squeezed, and everything was hard, and people were grumpy just in general. And what we tried to show is that 1.5% is where we've always been. The underlying data that's driving that is really strong. That the data, when you peel back general inflationary and cash rate pressures, is really strong. And we should celebrate that as an achievement that the industry's done. We are much better and delivering better and performing better than we ever have. And then, you know, that last comment that I've made probably 100 times in the last 60 minutes is, but we've had to, because costs are exploding, and we've got to make sure that we're then getting ahead of that cost explosion to drive some of this operational excellence, because I don't think that cost is naturally ever going to decline over a 5 to 10 year period. We might be able to arrest it in the short term, but it's going to continue to get more expensive to run a dealership. So we've got to continue to get better at running our operations. We've shown that, but we need to continue to do so. So we really wanted today to be a bit of a recognition of achievement for the industry, to say, well done. It's felt like hard work and it looks like 1.5%, but well done, because we're doing better underlying than ever before. So maybe that's a way that we should finish the session, Ash.
Yeah, a bit positive. Yeah, I like it. Well, look, thanks for taking time out of your day today to listen to what Lee and Andrew had to present, and thanks, Lee and Andrew, for all those interesting insights and sort of 10 lofty targets to reach for. In terms of one of those targets, the 100% constructive relationships with dealers, representative brands, we'll be sending out to dealers the results from this year's dealer satisfaction survey next week. So, and we'll be using those results to hopefully have constructive relationships with your OEMs and your dealer councils, and, you know, try and assist members with that symbiotic relationship where we can. So that's, you know, our contribution to those targets in one way. But yeah, what else does the AADA have coming up? We're going a bit quiet with webinars after this one. We thought we'd finish with a bang for the remainder of the year, but we do have the AADA AGM coming up on the 28th of October. That's a Tuesday. It's at 2 p.m. Sydney time. If you haven't got the rego link for that one, you can contact myself or anyone else from the AADA team, and we can get you registered for that. We'll, of course, be sending out a reminder for that one in the coming weeks as well. But yeah, thanks everyone again for your time, and we look forward to catching you again anytime soon.
Thanks, everyone.
Thanks.